Good morning all. I'm Jared Stevens of GMB Investments, TNT Limited, and thank you for logging on to the TTCIC's Business Insights webinar series. In today's installment, we delve into some of the differences between USD and local currency bonds and how safe these are as investments. So we're all on the same page from the onset. Let's go over our brief agenda. I would like to, among other things, introduce you to the GMMB Group, explain the need for investing, frame the context of the conversation through an understanding of the portfolio perspective and asset classes, answer the important questions of why should I invest in bonds and what factors inform whether to invest in a foreign currency bond. And lastly, summarize the aforementioned points and field any questions that may arise. A little about the GMMB Group. The GMMB Group is one of the leading financial groups in the region, serving over 200,000 clients in Jamaica, Trinidad and Tobago, and the Dominican Republic. The group provides a broad range of financial solutions, including investments, banking, remittances, and insurance brokering to individuals, corporates, and institutional clients. GMMB TT is represented by our banking arm, JMMB Bank, and the investments, of which I'm part of, is the local broker-dealer arm of the GMMB Group. So, on to today's business. Why should I even invest? So, what are the factors that should motivate you to invest? In some ways, we all want to be in a better financial position compared to where we are today. In the case of an individual, you have specific financial goals with different time horizons. These require an investment plan which considers the erosion of returns due to inflation, which stood at 1.7% as at May this year, and the dynamics of an aging population, with the risk of retirement savings being gradually transferred from employer to employee. Simply mobilizing capital and being invested in the market represents a huge step forward in securing financial growth for yourself and to those who come after you. So what can local investors expect? While we can make no guarantees with regards to the financial market's performance, based on our research and a read of the market to date, we expect that historically low interest rates in global markets, which are negative in some instances, cannot persist in the long run. As markets become more correlated, the speed at which volatility spreads from one region to another is much quicker. However, locally we appear to be approaching the end of our recessionary period, with first quarter of 2019 being our target date for recovery. But something has to give with the US dollar, as it's significantly overvalued and import cover will decline further until USD earnings from the energy sector rebounds to previous levels. So with that in mind, in terms of our portfolio perspective, we urge you to consider each investment decision based on its impact on your entire portfolio. This not only refers to what you may hold at a bank or brokerage account, but your entire personal balance sheet. So think assets, liabilities, you have expenses, you have your home, you have your car, you have investment properties, and the list goes on. So what does your current portfolio currently look like? Well, these pie charts are basic illustrations of portfolio types based on an investor's average risk threshold, which consider both his or her ability to take risk, which informs their risk tolerance, and their willingness to do so, which refers to their appetite. The allocations to a specific asset class, which we'll move on to next, are not prescriptive by any means, but would be tailored to your needs based on a complete risk assessment and development of an investment policy. So on to asset classes, and for the purposes of this discussion, we will focus on the major asset classes shown here. Typical cash, equities, bonds, and even properties. Each asset class, of course, has its own risk and return dynamics. What is also integral to the discussion is a proper contextual understanding of risk. This word is often misused and only in its negative connotation. However, risk on its own is neither good nor bad, but simply refers to a probability of an event not taking place as expected. Further, there is risk among and within asset classes themselves. While bonds are generally seen as safer than stocks, you can easily invest in a high-yielding bond portfolio if you're a more aggressive investor, which can be a lot more volatile than a large-cap stock per se. So today we examine one of the main asset classes in fixed income, and specifically bonds, which can be defined as large loans issued by corporations, governments, supranationals, so think IMF, CAF, World Bank. Foreign currency bonds therefore become a sub-asset class in the world of bonds. So why should you invest in bonds anyway? Well, my primary answer would be one of diversification. Historically, bonds have been important diversifiers to the risks of global equity markets. They also provide capital preservation and current income, and in many cases, even capital appreciation. That is, the increase in prices of your bonds. So for these reasons, the correlation between US and international bonds are actually quite low, especially relative to those of stocks, which is a good thing from a portfolio diversification standpoint. So just how big is the bond market? Well, financial media, so if you look at CNBC or Bloomberg, they typically cover stocks in a lot of detail. But what you mightn't know is that the bond market is a lot deeper than the stock market is, but it may not be as liquid. So this chart shows that as at 2014, the stock market cap only represented about 24% of global financial assets. In other words, the bonds value in a global sense is actually 3 times that of equities. So moving on to foreign bonds versus euro bonds, which is more specific to today's discussion. So as our discussion progresses, it's important to know the differences among, one, a bond issued in a domestic market in its domestic currency. So think of a domestic issuer, whether it's the government or a company like TSTT, issuing a TT dollar bond. A foreign bond issued by a foreign entity in a domestic currency is another example. For example, BP UK issuing a TT dollar bond. And a euro bond, which is where we will focus the remaining part of the discussion, refers to a bond that's issued in a foreign currency and listed on a foreign exchange. So for example, the government of Trinidad and Tobago last raised $1 billion last year at a rate of 4.5%. So of course, all of this would have little benefit unless there was actual value in considering a new investment option. So what's the value proposition of euro bonds? Well, the yield curve shown here illustrates the relationship, which is positive, between the return on a bond and its remaining time to maturity. More importantly, it shows that using the example of the government of Trinidad and Tobago, you're actually able to earn higher returns in US dollars, which is represented by the blue line for USD denominated bonds that mature in the next 7 to 10 years. Put another way, a higher return in what is considered the global reserve currency is especially attractive, even considering how illiquid TT dollar bonds are. There just aren't enough of them to go around local appetite. So moving on to the relative benefits of local versus foreign currency bond investing. So to be clear, making a case for relative value in USD bonds is qualified at best, and there are risks to consider on both sides. And as we said, risk is neither good nor bad, but a probability function more than anything else. So we will walk through a few of them here. Default risk refers to any likelihood of an investor not repaying interest and or principal in full or in time. This represents a risk that is present with both foreign currency and local bonds. However, in the case of local currency bonds, most governments are easily able to issue new bonds to refinance old ones. Therefore, for the same issuer that has both local and foreign currency bonds, the default risk would be greater for the latter. But to frame just how infrequently this risk applies, Moody's estimates that for 2017, the overall default rate for all bonds combined, that's both speculative grade and investment grade, is expected to reduce to just 1.5% from 2.1% in 2016. So the likelihood of default is actually quite low within the global bond universe. Exchange rate risk refers to the expectation or the probability that an exchange rate will move in a different direction than expected, but it's only present in foreign currency bonds, especially those issued by entities that do not have net earnings of USD. So think of some of our local issuers who may not be earning as much USD as expected. So that creates exchange rate risk, which is good or bad depending on what perspective you're taking. Liquidity risk refers to the availability and ability of assets and the ability to convert them into cash if needed. So whether you can buy or sell a security or liquidate if you need to, that all speaks to liquidity risk. And this is more prevalent with local currency bonds. The US dollar is the global reserve currency, as we said, while ability to easily buy or sell assets in our local markets is especially constrained. Economic risk exists for both sets of bonds, as growth prospects for a country affect their ability to repay debt. I would say, however, that you're better able to mobilize funds with foreign currency bonds because you have the option to change domicile of your investment to a more favorable economic climate. This option may not exist with local currency bonds from our perspective. And then there's asset class diversification, a point we raised earlier. Assuming that you already have some local bond exposure, it's much more applicable to foreign currency bonds. There are several sovereigns and corporates with varying correlations to different industry sectors. There are also political risks to consider specific to foreign currency bonds. For example, the likelihood of expropriation in Venezuela. A local investor may thus feel much more comfortable in their own environment where they're familiar with their current political climate and expectations of a certain outlook. Also, in terms of tax considerations, are your bonds tax exempt? They're subject to any tax treatments which are different to your own jurisdiction, depending on where you invest. So based on what we've seen so far, we've set up some regional options to give you an idea as to the universe that exists within the Eurobond space. So here's a snapshot of sovereign and corporate bonds throughout the region. I'm sure the names are all familiar to you, and you can see how different the returns are depending on their respective maturities, and you'll also see that the credit quality differs from one issue to the next. Taking that information forward, we've analyzed a medium-term portfolio with some of those familiar names and others, and also added a one-year JMMB investments repurchase agreement for some short-term flexibility. So for simplicity, we use a total face value of $1 million US, and based on the coupon profile below, you can see just how beneficial it is to incorporate bonds into your portfolio in terms of receiving interim payments throughout a calendar year. For those of you like me who don't have $1 million, we do trade smaller sizes, and we're happy to have those calls and discussions with you. So finally, what do I need to invest in US currency bonds, or any hard currency bonds for that matter? Well, far from being just an academic exercise, I'll conclude by providing you with the necessary steps to actually invest in USD or other hard currency bonds. You will require US or other hard currency liquidity. That's cash. And to be clear, GMB Investments is not a foreign exchange dealer, and we are unable to sell you foreign currency. But while we recognize the ongoing difficulties in the foreign exchange market, we do also recognize that there are billions of US dollars currently held in local deposits, mutual funds, and other investments. So the investable base is certainly there. Whether it's mobilized in these specific products may be a different question for a different time. We then need access to the bond market via a broker or an online trading platform, which we provide an example of here, and a custody account to safekeep the assets and receive interest and principal payments over time. Of course, feel free to give us a call to discuss the process of opening a new account. Again, thank you so much for your time and attention as we aim to educate you, the investing public. And I'll be happy to address any questions or comments that time allows. So our first question reads, given the lack of foreign exchange availability in the market, what's the prognosis for investing in Eurobonds? Well, as we said, risk is both possibly positive and or negative. So for our expectation, we expect the US rate to appreciate versus the TT dollar further. The rate at which this happens is unpredictable, but we do see that our TT exchange rate needs to be increased relative to the US dollar to reach closer to equilibrium. So for example, while a bank may be able to sell you funds at 6.79, for example, we see the real exchange rate as being higher than that. So in this case, the risk is actually good, because if you own a USD asset and you're receiving US dollars, you earn a positive appreciation of your investment. So I buy a bond, let's say a Trinidad and Tobago US dollar bond. I'm receiving US cash flows every 6 months from my interest payments. And those funds are actually worth more and more as you go out in time, as we expect the TT rate to depreciate further. So I hope this answers your question. Our next question reads, are there any tax considerations for local bonds? In our current environment, no. So both any capital appreciation as well as coupon payments, so the interest payments over the bond's life, are both tax exempt. So there aren't any tax considerations locally. But the good news is that's also the case in terms of USD bonds from our experience in the main. While there may be a few jurisdictions that have different tax treatments, for example, if you invest in a US dollar bond from a US corporate, or a bond that's denominated in US dollars from a regional issuer, those are not taxable to the average investor. That's within Trinidad and Tobago. However, throughout the region, based on the different tax treaties, those might be slightly different. So our next question reads, so we spoke a lot about risks, but what would you say is the main risk of bond investing or investing on the whole? So in terms of general investing risk context, risk framework, risk view, any return that you get on a security is a compensation for some type of risk or the other. So for example, in each economy, you view your local government's bond issues as a risk-free rate as when you're comparing different bonds. However, the fact that you're actually earning a positive return should indicate that there is some risk at all levels. So for example, while you may be able to invest in a treasury bill from a government at, let's say, 2%, that 2% indicates that there is some element of risk which you might not be considering. And of course, with corporates, their rate should be higher given the expected risk relative to a government. So, for example, a bond like, let's say, TSTT or Massey Holdings bond, those are all have higher rates of return compared to their relative points on the government yield curve, just because we expected that they have some incremental risk versus a government issuer. Of course, specific to today's conversation, there's also exchange rate risk to consider, which is big, especially within the local environment. And I actually view that risk as very positive in the current environment, just because of where our managed rate is. So it's, as I said, it's nowhere close to equilibrium, and the prognosis for further depreciation is there, and it's well researched, and you can definitely find a lot of literature in terms of a time frame, in terms of when that would happen. But I think USD bonds, so being increasingly long with USD exposure, is definitely a favorable thing at this point. So our next question reads, aside from the points mentioned within the presentation, how do I open an account with JMMB or with another entity? Well, so much like any other account that you open at any other institution, we of course need details from a client. So the standard KYC procedure would exist. We get a sense as to what you're comfortable with based on jurisdictions. For example, if you work within the energy sector, you may not want to be necessarily exposed to that sector in your investments, which makes sense because you don't want to double up on that correlation from a risk perspective. So maybe you feel more comfortable with manufacturing bonds from a company like, let's say, Caterpillar in the US, or banking if you're looking at a JP Morgan or a Morgan Stanley. And these are all high quality bonds based on your specific risk appetite. However, we do have clients who like more speculative types of investments. So things that we generally look at within the region, you see a name like a Digicel, for example, which would be considered high yield. Even Petrotrin at this point would be considered a high yield bond. And they all have different risk dynamics based on their operations, their expectations, and specifically to Petrotrin's case, they are quasi-sovereign, so they would have slightly different risk metrics compared to a relative corporate. So the other question reads, what's the average size of an investment that's required to place an investment, do a bond trade with you guys? Well, we don't have hard and fast minimums or maximums, but we do accommodate different sizes based on what we think is appropriate for the investor. So for example, if you have $1 US, investing in a bond shouldn't be your immediate goal. If you're just building up your investment portfolio, there are other products within the money markets that might be more helpful. So think deposits, mutual funds, and then as those funds grow, we are aiming to grow with you as well and move those funds over to larger asset classes where you could benefit more in the future. Another question reads, how would a new individual investor gain foreign exchange exposure in light of the difficulties that exist? Well, simply put, this is just a long game. There's no way you're going to get, for example, if I walk into JMMB Bank today and I ask for 10,000 US, I'm pretty sure they're going to laugh at me. Just because I think everyone needs to be cognizant of the current environment that we're in. But that doesn't mean that you may not be able to get $500, for an example, over a period of time. And maybe you develop that habit monthly, you build your portfolio, you build your wealth. So, as I said, while people focus on the availability of ongoing foreign exchange, we don't get the sense that everyone necessarily needs this large quantum at any given time. I mean, of course, there are importers and manufacturers who need certain amounts of USD to do their jobs. But on an individual basis, chances are you probably don't need 20,000 US dollars at any given time for an emergency of any sort. This is on average, of course. So with that in mind, I would say definitely a long game. Go to your bank regularly, of course, engage them in terms of what your expectations are and what their expectations are, and then we'll of course look to find a happy middle. And again, this is not me speaking on behalf of any banking institution, especially ours, but that's a conversation that they'll be happy to have with you once you go in. So the next question surrounds mutual funds. What's their place with regards to the conversation that we had today, and how are those integrated into future investments in bonds, whether they be local or foreign? So mutual funds are a great way to establish your investing habits. For example, you can set aside a certain amount of money each month, roll those into a mutual fund, enjoy some gains, which won't be absolutely high from a return standpoint. But the point is, you're developing the habit of investing on a regular basis and building up your portfolio, building up your wealth. So as that grows to whatever your critical mass might be, then you can move on to different asset classes that can really drive your return forward. So I see a final question. How diverse is the universe of bonds that you trade? Well, the easy answer is very wide. So any specific investment need that you have in hard currencies across most asset classes, we can trade for you. So this refers to financials, manufacturing, non-financials, food and beverage industries. So the sector dynamics are very different, as we said, but the opportunities are very varied and diverse. Of course, this also applies to different territories. So if you're comfortable with US dollars as your primary currency of trading, you can get just about any country in the world and be exposed to them favorably if you like a specific jurisdiction in US dollars, if that's your currency of comfort. So something like you can invest in a Singapore bond in US dollars, an Indonesian bond in US dollars. You can invest in Bank of India bonds in US dollars, or any hard currency that is most comfortable with you. So any hard currency, we have a lot of options, and we can generate portfolios based on your needs. So for example, as we said, we see rates rising within the medium term. So maybe you want to keep a short-term bond portfolio, maybe up to 3 years, just to manage the duration. And with that in mind, we can develop a portfolio of X names that you'll be comfortable with based on certain risk considerations and return appetite. So again, Thank you all for the questions. I was happy to present this short piece on USD bonds versus local bonds. And for any other questions, feel free to reach out to us as we'll leave our contact details. Thank you very much.